Good afternoon, everyone, and thank you, Quants League, for having me. It has been a wonderful session by Santosh Pasigi, and hope everybody liked it. Moving on to the topic on algorithmic trading, a more, I would say, a complex topic I would like to cover over here is on volatility. So just let me share my screen. Yeah. So the topic today I would like to cover is trading volatility. Uh, Over the years, what I have seen personally is the interest shifting from cash market to derivatives, and specifically into derivatives, traders have moved on to options trading. So options being an hot topic and a very close topic to my heart, uh, uh, I thought let's discuss more on volatility. This was discussed at one or two conferences previously. I would like to give a detailed explanation on this, as there have been a lot of queries on why to trade volatility, what is volatility, how we can trade the skew available on volatility, what is the skew. Let's hope I can clear some of the doubts today. Moving on to the topic, today's topic is trading volatility, trading skew of volatility, trading smile, and trading surface volatility. When we talk about volatility, what it is. A lot of option traders out there have been trading options from a directional point of view, from a non-directional point of view. There have been traders who are buying options. There have been traders who are selling options. There are strategies, algorithmic strategies designed to capture that specific movement. But inherently, all the pricing models are dependent on one important factor designed uh, in the option pricing model, and that is volatility. So when we talk about volatility, what we see on the screen, so most of the people out there follow India VIX, follow implied volatilities out there, and gauge what is the premium. So when the volatility is high or India VIX is higher, they feel that the volatility in the market is quite high, the premiums are juicier, and that is the time to sell options. And when India VIX falls, they feel that the volatility is low, and that is the time to buy options. Yes. Uh, if if I say with like on a non-theoretical part, that is what needs to be done. When volatility is low, you should buy the volatility. When the volatility is high, you should sell volatility. But what are the types of volatilities out there? When we say volatility of an option, what is that volatility of an option? What is defining the premium? So, volatility is nothing but just a standard deviation or dispersion of a given security. So, 1 second. Just this, guys. Yeah. So, volatility is what? Volatility is nothing but just a statistical measure to of dispersion of returns of a given security. So, how much the security is moving or the underlying is moving, which tells us that yeah, this security is highly volatile or it is less volatile. So, if we talk about Indian markets, we can easily say that Nifty is less volatile than Bank Nifty, and Bank Nifty is a higher volatile instrument. Why it is such that? Because the instrument, when it moves on a close to close basis, on a higher level, the volatility tends to increase. So, how it is calculated, so that is more important. But before going to how volatility is calculated, let us understand the difference between your historical volatilities or your implied volatilities out there. So when you are trading markets, you are trading implies. what does it mean that the option price or the option premium for a call or a put available out there is available probably at 20 IV or 25 IV or 15 IV. So what is that 15 IV or 20 IV? It is just an implied volatility or implied pricing of that option, what is perceived by the market players. So what the market is perceiving uh, of that underlying call or put is being priced and that is being shown. But what it is dependent on? So it is dependent on the underlying, but the underlying is not giving you implied volatilities. What the underlying is telling you is realized vols. So just quickly get back to what is actually realized vols or historical vols. So when we talk on volatility, it is very important to understand that realized vols or historical volatility is mandatory to be taken into consideration while trading options. So when we trade options, if you are trading just the direction of the option, it won't matter whether you are buying a low vol or a sell vol. Yes, if you are trading options and single-legged options for the direction of the market, and whether you are buying a call or put on a lower vol environment, yes, it would benefit. If you are buying or selling call or buying calls or buying puts on a higher vol environment and your direction doesn't come right, yes, it is going to hurt you. But if you are betting on the direction of the underlying and taking that trade into a specific instrument, that is a call or put, the volatility is, I would say, not materialistic. It is less materialistic in place because you are playing for a different Greek of that option pricing. You are playing for the delta of that option. The benefit on your strategy is going to come when your bet or when your prediction is going to be right. So if you are predicted that the market is going to go up, and though it is a high vol environment and you have bought calls and the market goes up, yes, you won't make probably that much of money, but yes, you won't lose money. You would make a good payoff on that. But on the contrary, if you are playing non-directional strategies that, like Santosh sir tool, like an iron condor strategy or an butterfly strategy or any kind of straddles, strangles, or any non-directional strategy out there, which you are not confident enough to say that the market is going to go up or down, but you are pretty confident that the market is going to stay range bound. That is where you take a call on taking a non-directional option strategy into place. So when you take any non-directional strategy in options, then delta is not the Greek on which you are playing. The only Greek what you are playing on is volatility, that is Vega. So when creating these kind of strategies, it is extremely important to understand the relationship between your underlying historical vols, your implied vols, that is your implied versus your realized vols, what is the environment you are in, and I'll show you in a couple of slides how you can play a non-directional aspect of volatility as well. So all the short straddles out there, or short strangles out there, or short butterflies out there, what are those doing? So those are taking a stab on the short side of volatility. So when I want to take a short stab on volatility, what does it mean? That I feel that the volatility out there is relatively higher, and the volatility I believe that is going to come down. The data is supporting that, and that is the reason I have entered into a short vol trade. So when I have entered into a short vol trade, what is more critical for me apart from the market movement is that the underlying volatility of the instrument falls, and that is where I can benefit from that shift in vol. So while doing that, what is important to understand is what is historical volatility. So let's suppose markets Nifty is moving. So this is the live data you can see. So for last 20 days, the market averagely is moving around a percent in either direction. Okay. So when the markets are moving 1% daily, that is 150 or 200 points daily, then you can reasonably say that yes, the volatility is there. Markets have been volatile, and we have been in a significant high vol environment right now due to all the events going on globally. So when such kind of events are going on, volatility is bound to increase. But as volatility increases, it has a very peculiar characteristics. So apart from its stickiness, what other characteristic volatility has? It is a mean reverting. It has a mean reverting characteristics in it. So as the volatility is going to go high, it is going to fall as well. So when the volatility is rising and you have taken a stab on long vol, yes, it is going to benefit you. But when it is falling and you are on the other side, it is going to hurt you as well. So how do we see that volatility is relatively higher or cheaper when we just want to take a stab on any non-directional trade available out there? So if I want to sell straddles, so my strategy is to sell straddles every day or sell straddles overnight and or iron condos. So what are the parameters I should be looking out there while taking such a trade? So the first and utmost important parameter out there is to look at historical vols or realized vols. So to calculate that, it is extremely easy. You need to have just the closing prices of your underlying instrument. Now that can be a daily closing price as well as it can be an intra-day closing prices. So it can be a 15-minute candle close or a 30-minute candle close or a 1 hour candle close or a 1 minute candle close. It won't matter. The change you can calculate. So that is just the difference between your previous closes. Once you calculate your change, what is your HV? How do you calculate HV? So HV is nothing but your standard deviation for that change. So when you calculate standard deviation for that change, you would get your HVs. When you get your HVs, when you multiply those by a square root of 252. Why 252? Because we are annualizing the vol. So whatever implied volatilities you see out there, 20, 22 IVs or 18 IVs, those are annualized volatilities. So to compare that, we need to standardize your historical vols to annualized also. So when you get that, you get your analyzed volatility numbers, annualized historical vols or realized vol numbers. So when you get those numbers, then you can compare. So it will have a look back period. So all your historical or realized vols are going to have a 10-day look back, a 20-day look back, or a 10 period, 20 period, 40 period look back, depending on the strategy you are trading. So all these parameters need to be back tested, optimized as per your strategy. But in isolation also, it is very important to look where your annualized vols or historical vols are going in. What does it mean? So let's suppose at the time of Ukraine crisis, Russia invaded Ukraine and it was a sudden event, for example, and there was a burst in vol. Now, suddenly your implied vols are trading at 30, 35. That is a relatively higher number. So when we are at 30, everybody would think that yes, the premiums are super high, so I should sell those premiums. Or in at the time of COVID, when the implieds went up till hundreds, 110, 120, these were the numbers which were not seen historically. So all the algorithmic trading or all systematic trading data is based on your historical model. So if your model is such that an event which has not been seen, a wall level which has not been seen previously is being seen, it means that we are at an extreme level and it should be sold. But what is more important to understand is what is your realized wall speed. So if the market is moving at a realized wall of, let's say, 100, and your implieds are trading at probably 120, then what does it mean? That you have a 20% additional premium out there at the current available prices set to extract out of it. But if your underlying is moving at probably 150%, and that is your realized walls are moving at 150%, what does it mean? That the market is moving very fast, whereas the premiums out there are juicier. They are giving you 120 implied walls, but it won't justify for selling them, but it would justify for buying them. So is a volatility a number, just a consideration to be taken while taking a long or short vol trade? No, it cannot be that yes, we are in a higher percentile or a higher IVP number, which can be seen and taken, that yes, I am in 90% quartile of an higher IV zone, and yes, that is the reason I am selling walls. It cannot be done like that, because if your underlying is moving much more than your implies, then you are bound to lose on your short wall trades. Whatever you do, or whatever delta management you do, or whatever repairing techniques you take to that trade, those are not going to suffice in helping you getting out of that trade. So that is the reason, the important thing to understand is that if your underlying or the realized IVs are lesser than your implies, then only you should sell volatility, or else you should buy volatility. You shouldn't go into selling walls. Okay. So whether it should be taken into isolation, no. Your volatility should never be considered, uh, because there have been models out there, there have been practices out there where people try to focus on IVP, IVR, and those kind of things. What happens in IVP or IVR is that there is a look back period involved in it. So let's say the look back period is for 1 year, and in that 1 year, the maximum volatility had risen to probably 30 levels. Now, suddenly, because of some event, my implieds are trading at 30, 32. What happens is my IVP, IVR levels are going to show up at the highest quartile. They are going to show in that 100% bracket. Uh, what does it mean? That if it is 100%, yes, it is very high, then it is bound to be sold. But if you don't compare it with your realized walls, the trade is not going to materialize in any profits. The repairs, what you do, the conditions, what you take. So while designing any strategy, considering any strategy on a short side, you should understand what is the Greek you're playing for. Most of the traders out there feel that no, theta is the only factor on which I'm playing. Volatility is not going to matter me that much. But it is on the contrary. Yes, theta is going to benefit you. But what happens is, because of your higher volatilities, the other Greeks are going to change dynamically. The system needs to calibrate or backtest itself for different volatility environments out there, different regimes out there. So it is very important to understand this relationship for a basic trade for a short or long wall. So over here, what I've done is I'll quickly show you. So this is a period from Jan to March. So this is the last quarter. This is the IVP chart of your walls, your implied walls. Okay. So what happened is, post Feb, we know what started to happen, and that is the reason your walls increased. And as you can see, the walls were trading at 100 percentile. Okay. Now, why 100 percentile? Yes, the market was on the left hand side. You can see the chart. The markets were falling, and as the markets were falling, the walls were rising and everything. And that is the reason your walls were exploding. Okay. Now, if I had taken any short trade, short wall trade, if I had done any short straddle, short strangle out there, or an iron condor out there, would I have made money on it? The simple answer is no. Uh, there is a high likelihood, there is an 80-85% chance that you making a profit in when the IVP is at 100 percentile probably is very low because because IVP is high. The strategy should make money because historically it has shown that when the IVP is higher, my short wall strategies work wonderfully. But in this case, you wouldn't have made money. Why you wouldn't have made money is if you look at this chart, the bottom chart, what is that? It is a relationship between your implied volatility minus your historical volatility. You can see clearly that your implieds, though were higher, your historical or realized walls were trading much higher. Okay. Now, when that happens, what happens is that the market is pricing, a straddle is being priced at probably 500 rupees of premium. Call is trading at 250, a put is trading at 250, and that is the reason it is being priced at probably 500 rupees. Now, the straddle is priced at 500 rupees, and the market every day is moving by probably 510 points. Now, what is going to happen is every day you're going to lose on the reverse gamma scalps out there. You are going to lose on the adjustments out there. And that is the reason if you look at the IV minus HV relationship, it will show you clearly that this was not a period. So last 2 months, I would say from mid of February till almost now we have started falling. So till this point, there was not a period to sell wall. So when the walls were actually rising, it was not a good time to sell volatility. But yes, as it reverses, then you see a change in the IBHV relationship, and that is where you can take a stab on selling those short wall strategies, those straddles out there, those strangles out there. But so is like long wall or short wall is the only trade available out there? No. So for beginners or for starting into options trading, these are the only two things you should focus on as we start trading in options. The first thing we do is buy options. When we buy options, we play for the direction into options or we go long volatility into options. Once we understand the trading aspect of options, generally traders move to selling options as well. So why selling options is they want to take a short stab on volatility or short stab on the non-directional component which can be achieved with the help of options trading. So when we take that into consideration, so as we move from a long trade to a short trade to a non-directional trade in options trading, similarly, on the volatility, you can play on all these three directions. That is, you can either have a long volatility trade, which can be constructed. You can construct a short volatility trade, or you can construct a non-directional volatility trade out there. What does it mean that? So when you trade any short straddle, short strangle out there, why do you do that? Is that probably you see that the market is going to stay range bound, and that is the reason you take a stab on the non-directional component available out there, which can be achieved through options trading. So similarly, if you don't have an idea of the direction of volatility, Let's suppose I don't understand or I cannot predict whether the volatility is going to go higher or lower. Is there a way to play a non-directional component of volatility? Yes, it can be played. These are the complex structures for which you need to understand option pricing, volatility pricing, and as you will understand that, you are going to uh, be able to create such kind of structures. But before moving that, let us understand how the volatility is priced across the option chain. So before moving to the theoretical part, let me show you some things. So fortunately, this has been a very silent expiry today we are experiencing. That is a good thing. Okay. So by now, everybody knows that the uh, puts or in the money strikes available out there are priced higher or carry a higher volatility, and the out of the money puts available out there are relatively cheaper. Why is that? So everything is based on the pricing mechanism. So everybody follows a Black-Scholes model, uh, which are shown in the prices. The implied walls are being shown using Black-Scholes model. But then why is the model showing different prices for different strikes? So previously to 1987, the Black-Scholes model or the model did consider geometrical Brownian motion into consideration. What it meant that all the strikes available out there, the whole option chain for an instrument was linear. It wasn't non-linear. So when I see that, what it meant is all the strikes out there. So if your ATM strike is trading at a wall of 20, your far OTM puts and your far ITM calls, as well as your far OTM, ITM calls and ITM puts were trading exactly for the same wall which was available at the ATM. Why was it such that? Is that people considered it as a normal distribution without having any fat tails for the movements which would occur in stock markets. But in 1987 of October, a huge crash came. A 20% fall was seen in a day. Uh, what happened because of that was a person who had bought a significant amount of puts, par OTM puts at probably 20 IV and had probably hedged the same amount of puts which he had bought with the same IV which was available for 20% had created a synthetic arbitrage. And people understood it immediately that the markets have fattier distribution, fattier tails out there. What does it mean that when the markets move out of two standard deviation, three standard deviation movements, and when we see a 4, 5, 6 sigma event, actually the movements are quite large. To compensate such kind of movements, people started understanding that the option prices for those par OTM puts for those par in the money calls should be priced differently than your ATM or OTM calls. And that is the reason the model evolved. And what we see right now is an evolution of that model, which is happening on a continuous basis. So when we went through big events, so whenever a big event occurs, like an event like COVID or an event like the Ukraine war, what we are seeing, or any events which will come up, what is going to happen is because of such events, the tails or the OTM puts or the risk premiums are going to increase further and further. So the sellers out there are going to demand much higher for the premiums to be sold to the buyers. So a buyer needs to pay a hefty premium on buying those par OTM puts. So when the buyer pays such higher hefty premium on it, what happens indirectly is that it creates a slope. It creates a huge slope in the whole option pricing scene. So your 16,000 put is now trading at 24.7 IB, whereas your current 17,500 is trading at 20 IB. Why is that 5% premium out there? So it is the same option price, just the strike is different. So this happened after the event, and now as the events keep on happening, after any event, there is a sudden burst on the whole surface, and the whole smile or whole option chain is going to get priced differently. Now, when that happens, there is a edge available out there which can be benefited by trading that risk premium out there. So, whatever premium is available, that can be extracted by creating some structures which can be traded using selling the skew available out there or trading the slope available out there. So, if you can buy and sell that slope, you can easily make so this to so if this is my option chain and this is the slope. So what can be done is now this and this. If the slope is steeper or if the slope is shallow, what can be done out there is that easily you can capture the difference available out there. And why, what, what does it signify? So let me show you that. Let's go back to today's. Okay. You can see a perfect smile available out there on today's expiry. So this kind of smile will evolve typically on the expiry day. Pre-expiry, the smile wouldn't be significant enough. It will start developing, but the development would be seen exactly when on an expiry day. So as you can see, right now we are trading at 17,460 something. So 17,460 is the lowest IV available out there, and all your ITM puts, ITM calls and OTM puts are costlier, and similarly your ITM puts and OTM calls are costlier, and this has created an excellent smile out there. But this smile is developed on that expiry date. So we know that this is going to happen. So if this is going to happen, we know that, then how we can benefit. So let's see next week. So next week, it has started to develop, but has it been complete? Is it completely developed? No. Is it going to evolve? Yes. So is there a way to create or to extract premium of this smile? Is there a way to extract any juice out there from this smile available? Yes. So there are ways to do that. And how to do that is more critical. So these kind of, so this is just an IV plot of all the strikes available out there. So if you see different plots, you will understand the steepness. The smiles don't get developed immediately, but are developed over the months available. So as the expiry comes nearer and nearer, you would see a clear transformation uh, into a smile being considered. So if this is what is going to happen, then just I would say to take a stab on it, the easiest way is that if I am selling this, if this is something I've sold, uh, or this is something I've bought. So this is the cheapest available out there, and this is the costliest thing available out there. So by principle, any trade would benefit that if you buy something cheap and sell something costlier, then you should make benefit out of it. So similarly, on the trade, on the skew, you should understand whether 16,500 call or put, whether it is trading cheap relative to your ATM. ATM is trading at 18 IV, and your 16,500 call and put is trading at 24 IV. So whether 24 IV is cheap or probably expensive. So if you understand that relationship, then what is going to happen is you are going to be able to sell those OTM calls and OTM puts, and probably buy some ATM calls, ATM puts, or reverse. If you feel that it is costlier, then you can sell your ATM calls and ATM puts and buy those OTM calls and OTM puts. So how to gauge whether that is cheap, that is expensive or not expensive? To show you that, let's get back to the presentation. Okay. So before moving to creating that, let's understand some features out there which are available in Nifty options. So as I showed you, volatility are steepest for small expiration as a function of strike, shallower for longer expiration. So what does it mean that? So volatility, so your volatility for today's expiry, so 31st March expiry, the volatility for a 17,000 call or put would be higher, much higher than the volatility for a longer expiry, that is your May expiry or June expiry or December expiry out there. Okay. So this is the data. So all the data, what you see out there, apart from the references, what I would share, are being these models have been developed in-house by us. So we calculate all the volatilities. So we don't follow a Black-Scholes model. We derive our own volatilities based on some different models out there. The data is being calculated, the volatilities are being calculated by us on a minute scale, second scale, tick scale. So everything is captured, and I'll show you some codes. So in the next session, we can share you some codes and we can walk you through how the volatilities can be calculated, how option pricing, all the Greeks are calculated using different models out there, and how you can create your own portfolio of Greeks using various coding techniques, how you should use the various tools out there that can be shown in some other presentation. So these are the slopes. So we have seen a negative correlation between changes in the implied ATM volatility and the underlying. So most of the people know out there is that if the market crashes, the volatility tends to go up, and if the market rises, the volatility tends to fall. So this will be valid when we are moving within that 1 or 1.5 standard deviation. So when we move probably just 0.5% or 1% or 2%, then these things are valid. But what happens when we go out of that movement, when we see a 4 or 5 sigma event, then these changes don't occur, the distribution changes completely. So lower strikes are usually higher than higher strike volatilities. Yes, this is visible in the market. After large sudden market declines, the implied volatilities of out of the money calls can be greater than for ATM calls. Yes. Uh, what it means that when we see a sudden fall in the market, your OTM calls suddenly start becoming pricier. Why they start becoming pricier is that for every fall, there is a perception that the market is going to rebound very fast. So when we feel that the market is going to rebound very fast, then the pricing on your OTM calls becomes heavier and heavier, and that is the reason the curve rebounds from itself, and the pricing is different. Okay. This is the exactly same thing which I've shown you. This is the today's thing. You can see a perfectly smile available out there. So now I'll show you a model. Sorry guys, messed up once again. I'll first walk you through the calculation, the distribution there. So what I've done over here is that, so going back, so this is just a sample set, but I've taken a data for last 4 years. This is an intraday data of 15 minutes. So every 15 minutes, the data is populated. What is populated is the future price, the future close for that 15 minutes. That close is rounded to its nearest 100. So if the close is 166, it will be the ATM considered would be 17200. For 17200, I have taken the seven corresponding ATM call and ATM put, as well as I've just done this analysis. The model has been built on a 96 moneyness option pricing. So what is a 96 moneyness is just that 4% out an ITM call or an OTM put. So if my strike, so let's suppose we are trading at 17,500. What is my 4% right now? 7, 16, 8, 900, something like that. 16,800. Okay. So my 96 moneyness strike would be 16,800. So similarly, 17,200 is the ATM, then 16,500 is my 96 moneyness. So I've taken out this data for every 15 minutes continuously. Okay. This is a continuous data set wherein the data set shifts over for 7 days to weekly. So what does it mean that on the last Friday, I'll start I'll cut down the data set and I'll shift to the next monthly expiry. Okay, and see, check the data set again. Okay, so this is my ATM strike. This is my 96 moneyness strike. These are the days to expiry. So 29.25 days to expiry. What was my ATM IV? What was my 96 moneyness IV? What was my call price? So what was my ATM call price? ATM put price at that time stamp, so 9:30 in the morning. What was my 96 moneyness call price? 96 moneyness put price. Okay. And so once I populate these things together, I have done this. So this is a continuous series. Uh, for the sake of making the data set lighter, I've just taken it for a period of 1 year. You can go as long as you want. It won't matter. So this is that. Now what I've done is for calculation of the slope, I've just taken a difference of the IVs out there. Okay. So what was the difference of 15 minus 90? So this is the slope. That is slope for my 96 monomers. Okay. So this I've taken. Now what I've done is I've taken a 20-day rolling average of that slope. Okay. So this I've done it. So once I take that 20-day rolling average, I've populated everything. Then I've taken the standard deviation of that slope. What is my standard deviation of that slope available? Once I do that, what I get is I get my mean, median, my standard deviation, and one standard deviation and two standard deviation. Okay. And then I get a distribution. So the distribution, as you can see, it is skewed. It is a positive skewness is there. The kurtosis is quite visible. And these are the standard deviation marks what I have created. So this is one standard deviation. So one standard deviation, two standard deviation, your median. So your median is 3.05. My one standard deviation is 4.21. My two standard deviation is 5.37. My lower standard deviation minus one standard deviation is 1.89, and my minus two standard deviation is 0.7. So what does it mean that if I do on a continuous series basis? So if I look at the option chain as a one singular series going back probably 1 year, 2 year, or 3 year, I can say with a great degree of confidence that a 96 moneyness strike to an ATM strike. ATM strike is whatever ATM strike right now we are. So ATM strike to your 96 moneyness strike has the relationship between the slope, what is present, can be plotted with this distribution, and the median for that slope is such that it is 3.05. Your one standard deviation is something and your two standard deviation is something. And if the slope is steeper, then I can sell that slope or sell that skew. If that slope is not steep, then if it is on the left side of the tail, then I can buy that skew. So what does it mean that? So this is my slope. Okay. Now historically, I've seen this width. I've calculated this. I've calculated the slope. So let me draw and show you. So now, historically, I know that 96 moneyness option, the slope is this much. Now, I can calculate on a continuous basis. I've got the model has, I have said that the median is 3.5, 3.05. Okay. Now, if I see something in the range between probably 4 point or 5.37, what does it mean that it is coming over here? So if the slope it is steeper, so what it means that this slope, the steeper slope is costlier and it is going to go down. So the slope is going to go back. So when I know that, I can create a short skew trade out there. And if something is available on the left tail, I can buy that and with a high degree of confidence and say that the slope out there is I'll take all the questions later. Okay. So the slope out there is not steeper, and I'll buy that slope. Okay. So this is just for 96 moneyness option. You can do it for 99 moneyness, 99.5 moneyness, 98 moneyness, 95, 94, 90, all the way down, or all the way up as well. So you can see the right side of the option chain, the left side of the option chain, and you can build a model anywhere. So I've just created this simple model for the sake of understanding. Unfortunately, I didn't get any traits to show you for the current. In the next slide, I'll show you this. Let me do this. Okay. So yeah. So this is the 7th and 28th April. So today's expiry data I haven't taken because the the back test, what I've done has been done for shifted for when the dates to expiry are lesser than 7. So at 6 days to expiry, the data set has been moved to the next series. So that is the reason today's data set I haven't taken. But just for understanding purpose, what I did was I took the spot value just around 2 hours back when it was trading around 17,480. The 7th April, so the ATM strike came out to be 17,500. The ATM call was trading at 180. The ATM put was trading at around 183. The IVs were trading at around 18. Then my 96 moneyness option came out to be 16,800. The call and the put were trading at 725 and uh, uh, 25.6. The IVs were around 22. The slope was 3.93. So in the last slide, we saw that my median is 3.05. Now, if my median is 3.05 and now I'm seeing just probably 3.28 or 3.93, then I'm not near to my one standard deviation also. So I'm just over here, somewhere over here. So I don't want to take a stab over here because this is what normally occurs and this is not something extraordinary. So I shouldn't take any trade on that. But if this would have been there, then we could have taken a trade. I'll show you that. Uh, and I've done it for 20th expiry as well. So the monthly expiry of April. So similarly, 17,500 was the ATM strike. Your ATM values was there and the slope was 2.26. So it was not significant. So unfortunately, I can't show you a live trade which you can construct today. But fortunately enough, I had given a similar presentation at the time of budget. And at that time, as the event was a known event, a significant event, till last week, there were fantastic trades available because of the crisis out there. But suddenly, everything has dropped, and though RBI policy is there on 7th, still the walls haven't picked up. The pricing is relatively nicely in the range. So we don't have anything for next week. But let's go back and see what happened in the last week of January. So this was a 27 Jan and 24th Feb. So 27 Jan was similarly an expiry. 24th Feb was the monthly expiry. As you can see, the spot was 17,617. The ATM strikes were 17, 600, 600. If you see the slope was 5.9 and 1.04. Yes, bang. So when we get something like this, a slope like 5.9, so when you see 5.9 or 1.04, what does it mean? 5.9 is way out there, okay, and 1.04, it is over here. So now I've got two trades in place, one in a weekly expiry, which I can take a stab, on the short side, and one on a monthly expiry, which I can take a stab on the long side. So simultaneously, I can create two trades. One is a short skew, one is a long skew, and the data is supporting me. So that is the reason the slope is there, and therefore the one we are taking the trade is a short skew. So this is an old trade. We can, it's already 2:30, so won't be able to go back and download everything. So this was the trade what was taken. So what was the trade taken? So the trade to do is, as you know, I want to sell the skew. So the slope is steeper. So I want to sell, which is, I think, which is priced costlier, but it shouldn't be priced that much costlier. And which is priced lower. The ATM strikes, which are lower priced, are actually should be priced much higher. Means the prices needs to, the wall needs to go higher. So what I do is I sell which is available, the ITM calls or OTM put. It doesn't matter whether you create a call spread, you a put spread, anything. The structure can be created in multiple ways. As you start trading it, you will understand how to create those structures, how to manage those structures. But that is something different. First, you need to understand what needs to be done. So the lefty, the all the ITM calls, the 96 moneyness calls or 96 moneyness puts, which are trading at the IVs out there, the 24 IVs out there, is comparatively costlier than it should trade to their ATMs. Okay, so that is the reason I'm going to sell ITM calls or OTM puts, that is 16900 calls or 16900 puts, and I'm going to buy 17600, that is the ATM calls or ATM puts. Now the critical component in this is that rest of the Greeks are needs to be balanced completely. So when I say rest of the Greeks needs to be balanced completely, is that you are not playing for the direction of the spread. You are not playing for the market direction. So delta needs to be neutralized completely. Before neutralizing delta, gamma neutralization should be done. Why gamma neutralization? Because that is where all the other Greeks, the thetas, your vega, can be neutralized. So your gamma neutralization is must. Your delta neutralization is must. So once you neutralize your gamma and delta, then what is going to evolve is a structure which is going to be paid off with the help of your third order Greeks, your fourth order Greeks. Basically, your skew is going to get paid off when it settles back. And this was the trade which was set up. So I had sold the 16900 calls. I had bought the 17600 calls, and the residual deltas were balanced using a synthetic. So 17500 call put, the deltas were balanced. So this was a trade done for 27 Jan expiry, where I felt that the slope is steeper and it should be sold into. On the contrary, for the monthly expiry, as we saw, the slope was just 1.04. So that is way below the historical backtest we did or the data analysis we did. So from that, we understood that it should be bought into. So when we say it should be bought into, exactly reverse of that should be done. So what should be done is that the 17600 calls were sold, the 169, in this case, I have used 17,000. So 17,000 calls were bought, and the residual deltas were balanced with the help of synthetics or future or anything like that. The more important things to understand in this is that uh, your days to expiries for this trade to be exited is should be more than 3. So you shouldn't carry it in the last 2 days or 1 day of expiry, because it is going to get very critical. If once you start practicing, start getting a fix on it, start understanding the data available out there, then I would say you can start playing for the 1 day, 2 day DT or even 0 DT as well. But before that, just stick to those basic rules. Get out of the trade before 3 days to DT. Then the important part is whenever you find such trades, you are playing for the volatility differential out there. You are not playing for direction. You are not playing for theta. You are not playing for other Greeks. So that is the reason the neutralization of other Greeks is extremely important. That should be done not on a continuous basis because the spread is the Greeks are not going to move that much. And the third part is these trades won't be available every hour, every minute, or every day. This will happen once a week, twice a week maximum, once a month, twice a month maximum. So look out for those spreads whenever such movements occur, and you can take a stab on it. Okay. So this was something I want to explain the surface and calendar spreads, but let's keep it for some other day. So now let's take 2 minutes for Q&A, and I'll wrap it up because it has been more than 1 hour. We have.
Tanmay ji, you can take your time, no issues.
Okay. So now let's go to Q&A. If anyone has any questions. Any questions? Either I gave an excellent presentation so that everybody understood it really nice, or it was so boring that nobody understood everything. We have some recordings and presentations can be sent out. The team would be able to answer to that. So thank you guys. Yes,